All right. Hey, what's going on, Cashflow hackers? It's Chris with Life 180. I got my buddies here, Matt, Ian, Jeff, and Michael. We are going to be going through whole life insurance as a banking alternative today. This is something that's been coming up a lot in a lot of comments, a lot of videos that we're doing, a lot of people engaging and asking questions, talking about why would we do this? What is the use case? I did something the other day. Somebody was like, well, I just had to burn through my emergency fund, to do some home fixtures the other day, and what would be the use case to actually utilize whole life insurance as an emergency fund? And so there are so many reasons that you would want to do it. But I'd like today for us to, because I know we all love the idea, right? So let's look. We're all going to realize that we're coming from the same perspective. We love the idea of utilizing whole life insurance as a savings alternative, as an asset, as a banking alternative for a safe, liquid, accessible capital. Okay, so that's fair. We're all going to agree on that. What I'd like is two things from everybody on this call is, first, tell me why. Like, what are your favorite reasons, either in your personal life or what you've seen with your clients on how they've used it and how it's maybe helped them. And then secondly, let's talk about some of the risks. Like, let's talk about some of the dangers, of said strategy as well, because I think it's important to understand, what those are. And I'm gonna let you guys go first. I'm gonna start with Matt. So give me if you can, Matt. Talk to me about, why do you love whole life insurance as a savings alternative? And this is coming from somebody who, sold Index Universal Life for 8 years, and now is hardcore in the whole life category after doing that. And you believe in whole life insurance as a savings alternative. Notice I didn't say investment alternative for everybody tuning in at home. It's a savings alternative. And so as a banking alternative, talk to me about the good, the bad, and the ugly from your perspective. And by the way, I'm going to try to put like a 5-minute timer on everybody and I may interject. So try to time yourself and that way we keep this moving, and keep it really tight and focused, and then we'll keep moving on.
Well, I think, there's a lot of things we could talk about as far as, being a banking alternative. But for me, I come from more of, I love whole life as a banking alternative more for peace of mind and control. I don't know if you guys, on social media, we have seen a lot of people report and videotape them going into their banks and their banks refusing cash withdrawals and demanding reasons just to access their own money. And when you look at that, that's kind of scary. And there's a famous YouTuber that promoted a bank, and they recently they're getting in trouble because the banks are kind of having some issues with withdrawals as well. I think it was April 2020. There's something called Regulation D, where I think the feds they put some regulation in place where it limited withdrawals. So for me, it's just kind of scary that you're going to save money into a bank where the regulations, the banks, the government, they can do things to change your accessibility. They can change the rules. And to me, we kind of grow up thinking bank is the safest place you could put your money, but it's actually hard because you don't have the control. And so for me, it's not more of the use case. It's for me, it's really the peace of mind and control. In whole life, the government's not going to come and try to take my money, and the carrier's not going to tell me, hey, you can't pull that money out and stuff like that, like a bank can. So I like the idea of just having more control of my money, and then the peace of mind and the security behind it. And let's face it, look at the economy, what's happening. There was a recent study by Claros Group. They released a study, and they're talking about collectively banks face between 700 billion to 1 trillion in unrealized losses due to high interest rates. And I think there's just a lot of cracks. They suspect hundreds of banks are going to have issues. And to think that in an unstable environment, that's where your money, that's where you're keeping it. To me, I think whole life completely beats it out of the water in that sense. I think a minor downfall would be if you wanted the money today, If you wanted to pull out $1,000 out of whole life today, it might not happen as quick. If you pre-plan, you could get around it, but I really don't see any downsides.
You don't see the downsides. All right, so we'll go to that. Well, I mean, yeah, I get it. The downside is it's going to take you. So what you're saying is the downside is it's going to take you 72 to 96 hours to get your money typically,
Right.
Whatever you need. So the downside is like whatever money you think you need within an immediate basis, like i.e. go to the ATM and snag some cash.
Right.
You better have that liquid. Don't keep that in your whole life policy.
Right. Yeah. That's
okay. Fair enough. All right. Rock and roll. All right. So that was a good job, by the way. You stayed totally on time. We're going to see if we can all, keep this super tight. It's going to be fun. So Ian, welcome back after a couple week absence.
Yeah. Yes. Back.
Nice. Well, it looks nice.
Yeah. Thank you. Yes. When it comes to my feelings very much mirror Matt's. When it comes to my personal finances, I find that I'm very conservative. The thought of going to the World Series of Poker and entering a gambling tournament like that is just, to me, it's like way.
Fair enough.
So, but that's just me, and I know that everybody's got a different set of beliefs and a different set of values. And to piggyback on what Matt said, since the beginning of the United States, there have been 17,000 banks that have failed, and in the last 150 years, there's only been one major mutual life insurance company that's gone under. And when you think of it that way, we feel like we're safe and we're kind of isolated here in the United States, and we see the news, some bank runs and things that are happening in other countries. But it's almost like out of sight, out of mind. It's not happening in our backyard unless you happen to live in San Francisco and you were there when the Silicon Valley Bank get their money out of the bank. And to elaborate again on what Matt said, when Jerome Powell, who is the chair of the Fed, says that we should expect bank, that means something. And no matter how much they try to downplay it, there's a ton of people who are very influential investors who are saying, like, they're pointing out the facts that the system that we're in, that it's not sustainable. And when I think of something that is going to be sustainable and that I would like to, in my conservative view and wanting to maintain control over my situation and not put my future in the hands of a stock market or of my future in the hands of somebody who's gonna just do what they will with my money and hope for a positive return, like whole life insurance is the obvious, the obvious answer for me. And the title of this video is the secret to using whole life insurance. Well, it seems like a secret now, but if you go back 70 years to the 1960s, like, it was what everybody did anyway. I mean, they didn't use it as a banking alternative per se, as in the way that we're talking about it the majority of the time, but it was I think the population of the and there were just as many whole life policies in force then as there are now, which tells you something, that there was a different mentality and a different way of doing things. I think what we think of as the conventional wisdom is not all that conventional. This is a relatively new way of thinking and way of managing money that people are utilizing now to their detriment in a lot of cases. I saw a study that came out recently that said 96% of Americans reach retirement without enough money. So I think that speaks, and that's a reflection of the fact that the conventional wisdom that we've adopted over the last few decades is not serving people. And for me, like, thinking about the way people used to do it and the success that the people used to have is something that I think that a lot of wisdom can be gleaned from that. And So the downside of it is like what Matt said. You don't necessarily have you don't have a card where you can just stick it into a machine and get money out of. There is a little bit more of a process, and quite frankly, I think for a lot of people that might be something that's beneficial to help people manage their spending habits. But on the other side, if you need immediate access to money, it's just a little bit different. It's more of a process. It's not exactly like a bank. So I can see how that can get conflated for people. And when you say banking, people take your money out right. When people learn how it actually works, there's a little bit of friction there and a sense of discomfort because they can't have that convenience of having the card. Is Chris still on? Did we lose our fearless leader?
We might have lost him.
I think we did.
We're stuck on Ian.
We're stuck on you, Ian.
Yeah, lucky me. The rainstorms in the Dominican Republic in time to strike. I know. I had a timer on, so I know I was good for the 5 minutes.
Well, Ian, kind of talk about the uninterrupted growth that you can have access to within your whole life policy.
Yeah, I think that's one of the big things that people don't necessarily understand or think of, that uninterrupted compounding growth and the amount of power that can have, and the amount of stability that can bring to a person's financial system. There's not a lot of there are different investments where you can get that uninterrupted compounding growth, but it's one of those things that's really, it's hard to it's it's hard to really get a grasp of how meaningful that is, and it's counterintuitive when you think about money and time. Like the time aspect of uninterrupted compounding growth, it doesn't make sense in our minds, because if you were to put $1,000, if you were to put into savings, or say whatever amount, say it's $1,000 every month. If you put $1,000 away every single month, and got a 7% rate of return, I forget the number. You're getting close. I forget exactly what the number is, but if you put this exact same amount of money away at a 5% rate of return, so just the difference of 2% rate of return over that same 50 period of time, the amount more than half. So from 5% to 7% over 50 years, you only have half as much money. So that compounding growth, it's counterintuitive, because time does weird things to money when you stretch it out, and especially the longer it gets. And that's one of the really powerful benefits of having one of these policies in place as a permanent policy that you're going to have for your entire life. And it looks like Chris is back, so I'm going to hand the baton back over to him.
There we go. Way to carry the weight. Yeah. So, welcome to the jungle. It was raining hard for a second, so it's like this little burst came through. So we're good to go. All right. I don't know what order we were going before, but now we're going Michael.
Okay. Yeah. So I think for myself, in particular as a father, I really value the insurance, right? So, I could put my money in a bank. Can you hear me?
Yeah, you're good. You're good.
Oh, okay. Somebody messaged my mic wasn't connected. So I think of it this way. If you're looking at a bank, right? You have your checking account. This is not to replace your checking account. You still need something liquid. You still need your debit card or however you pay your bills, right? But then you look at your savings account. What's really the purpose of having a savings account? It's not an investment account. It's just emergency fund. It's just there, for you to have in case you need it or for an opportunity. You can save for certain things. So when you really understand what the savings account's for, it's not an investment vehicle. It's not a checking account. It's just like a fund. It's an emergency fund. It's an opportunity fund. It's there when you need it. And so, when you look at using whole life to fill that purpose, all of a sudden you actually get some growth, right? I think that's important, but you get other benefits. I think it's an enhanced emergency fund because of the death benefit, because of the living benefits. So not only do I have my pool of money, when I need it, for emergency, but if I were to get ill, if I were to pass away, me or my family, my daughter would have a larger pool of money from the insurance company, and that would be there, right? And so for me, the insurance portion of this is super important. Me knowing that, hey, I have a plan in place. I'm strategically positioning myself for opportunity. Of course, I don't think in the worst case scenario. I know it's an emergency fund, but I'm looking at it more as an opportunity fund, because how do I use this, money to acquire real estate, to take advantage of, crashes in the market. So I'm looking at it as a safe place to have my money for those opportunities. Like I said, the insurance portion, obviously, if something happens to me and I'm not able to execute my plan, hey, you know what? My daughter is going to have a nice large lump sum of money for her. And I think the protection, right? You're protected against taxes, because even if you were to maybe say put the money in a brokerage account, because can you get, a 4 to 6% return in a brokerage account? Yes. Can it be liquid? Yes. But you are going to pay capital gains tax, right? So you're shielded from the taxes. And the other thing too is, you're shielded from bankruptcy, from litigation, right? From judgments. So, it's just a perfect place for me to protect my money. Obviously, I think on the downside is all those benefits obviously do come with a cost. So if you're going to dump in a large sum of money, that first year, you might only have access to 80, 90% of that money, maybe even a little bit less, depending on, your situation. But within a few years, you make that up because of that compound interest, because of the gains. So for me, it's like there's a short-term disadvantage, but you're getting so much more in the protection that it easily offsets the negatives. Did we lose Chris again?
Sounds like we might have lost Chris again.
I think so. So, Michael, carry it away. We got Tyler in the house.
Tyler, is there any comments? No. Yeah, I mean, I don't know about you guys, but like I said, I can't even say little girl anymore. She's 14, so young lady. As a father of a young lady, these are things that are important to me. And I know sometimes, a lot of agents out there or people, they just focus on the cash value, not really realizing like, no, this is super valuable stuff that you're getting along with the cash value, right? Those extra protections. And to me, it just makes 100% sense. I don't know about you guys, but that the cost associated with the policy, right? Obviously, like some of the time it'll take like 5, 6, 7 years to break even, from what you've put in, but losing 10, 20% in the first year and obviously catching back up within a few years, but having that massive death benefit, I mean, it brings comfort to me knowing that if I don't execute my plan, that my daughter is going to have that money. Or even if I get ill and I actually need to access the insurance company's money, it's there. Yeah, I'll share a story real quick. A couple of years ago, and I don't have any health issues, but a couple of years ago, I was under a lot of stress. I did go to the hospital. I passed out completely. I was dehydrated. And I remember I was sitting in the emergency room. And, I have my coverages and I didn't know it was wrong. Right. And I remember just sitting there thinking, like, thank God I have critical illness coverage and chronic illness coverage, because I don't know if something serious is wrong, but if it is, at least I have the money to like pay for the appropriate, to take care of myself. Right. So, luckily we ran some tests. My doctor said, hey, nothing's wrong. Everything, all your levels are good. You're just dehydrated. And he said, sometimes we just have encounters that remind us that, we're mortal, like we're not going to live forever, and I think you got to think ahead and think of those things. And I know us in this space, we really focus on that. So.
Yeah.
Can you kind of highlight the argument? Some people will say, oh, well, the returns aren't that great with whole life, right? Can you kind of talk about the mindset more specifically, like, oh, the first 7 years, you might not even break even and your rate of return isn't that great when it comes to that. But if you were to die during that time, you would get a far bigger return than what you would have been able to achieve in the market in the first place. Can you kind of talk about that?
Yeah. So, there's a lot of people that want to put the money in 401ks or, Roth IRAs, different investment accounts. Right. And I think the first thing we got to like get clear on is, what lens are you looking at this through? Is this an investment alternative? No, it's not. Right. And Chris mentioned that right in the beginning, like it's a savings alternative. It's not an investment alternative. Right. So let's get real clear on that first. That way we're not trying to get 8% returns, 10 or even higher returns, because that's not the function of whole life. Right. So if you're arguing for that, that you need to be doing something else. But I think the other thing is the strategic positioning of your money, right? Because you can do a buy hold strategy. And a lot of people, that's what they do. Right. But if you look at people that are successful, if you look at like a Grant Cardone, right, he says, no, save money, don't invest it until you have enough so you can go out and get a 20% return, 30% return. If you look at like Warren Buffett, Warren Buffett always has cash at hand. Why? Because he's waiting for opportunity. Right. And so through this, yeah, you're only getting the 4 to 6%. Let's just call it 4%. Let's say you get 4% return, internal rate of return over the years, but you're strategically positioning yourself outside the market, right? You're strategically positioning yourself where you have control, you have liquidity, and you have access to capital. So when the opportunity comes up, and by the way, it might not be the stock market, it might be the real estate market, right? Because how big of a deal is real estate, right? That keeps up with inflation. You're going to build equity through your real estate. You can lock in a monthly rate. You can pay off your home, and obviously it gives you a place to live. So it can really enhance your life in a lot of ways. But also, like the stock market crashes, right? We'll take 2008 for example. You had a 40% crash in the stock market. So if you had, for every $100, you would be at $60. Right. So if you had $100,000, let's call it $60,000. Well, for you to get from 60,000 back to 100, what return do you need? You need a 67% return just to break even. Right. So for the people that say, oh, well, you just buy and hold and hold longer, it always comes up and it'll always, pass where it was before. Even if that's true, right, you're going to spend, like, it took till 2013 to break even. So you lost from 2008 to 2013, you lost 6 years. Well, what if you were in position to buy when everything was on sale? And it's about strategic positioning. It's not about the returns you get in the policy, but it's about the position so you can go get massive returns outside the policy, right? Because if you were to buy at 60,000 when everything was on sale, you would get a 67% return while everybody else was just breaking even. Right. And then as the market passed, you'd be looking at 100%, 200% returns on your money. You can easily pay the policy loans back. You have another account outside of your policy. Right. And so now you're being very strategic with your, your financial positioning. You're taking better advantage of things. And they say, like, people people become rich during down markets. People become rich when things are in chaos, right? And so be in position to take advantage of that. And we do have Chris back. Awesome.
Hey, isn't this fun? So here's the deal. Now the internet's working, but my computer crashed. So it's not, whatever. So now I'm on my phone. I get to walk around, which is good. So yeah, no, I didn't hear what you said, obviously, but thank you for holding down the fort. Let's move on to Charles.
Yeah, absolutely. So yeah, there's a few takes that I have on using a whole life policy as an alternative to a bank account or banking system. I would like to say that I don't think it's going to replace the banking system altogether, but I do think that it's important to kind of diversify where your money is. And I think there's a lot of use cases that are super important when it comes to whole life as a whole. And that's why I'm so comfortable putting my money there. So the way that I view, putting my money in a life insurance company, a life insurance company's whole job is to mitigate risk. They're experts at it. You can look at their track record. You can look at the dividend payments that have been paid for over 100 years through 3 different currencies, through World War I, through World War II, through the Great Depression, through the Great Recession. You've always seen that even though they're not guaranteed, they're paying a dividend beyond what the guarantees within the contract are. So that's incredibly powerful. Now, when you view a bank, how a bank makes money by taking on risk. They give out a loan, and when they give that loan to somebody, they expect people to pay it back. Well, they don't always pay that loan back. And when people start pulling money out of the banking system, that's when issues occur. So right now what we see is higher interest rates. And what people are doing is they're pulling out their money and they're putting it in bonds. Well, when they pull that money out of the bank, it kind of drains the gunpowder that the bank has to go and make more investments. So it becomes unstable. And that's where the problem occurs. With a whole life company, they have to be solvent. The actuaries are looking at this, at your policy, everybody's policy, at the solvency of the company, and they're going, we know that this is going to occur. We know that this is going to occur. So that's why you can have so much confidence when you're putting your money in a life insurance or mutually participating life insurance company. And you always want to make sure that, they have a high Comdex score and they have, amazing track record. Those are very important aspects to implementing this in your life. I would say that one of the downsides within a whole life policy contract is the fact that, at least for my policy, the company that I use, contractually, the company can hold your money for up to 6 months. So if you were to request a loan, they could hold your money for 6 months. Now, I have never heard of anybody having that issue. I've only heard of people getting their money within 3 to 5 days. So, but with that said, I think it's also important to put a little bit of money on the side and utilize the banking system, the traditional banking system, as your buffer. So have both, right? To say put all your money in this product, I don't think that's a good idea. And to try and eliminate the entire banking system, I don't think that's a good idea either. And the reason I don't think that is because sometimes you can get cheaper money elsewhere. And sometimes you have the belief that if you take on more leverage, maybe from a loan from a bank, that you can turn that money into, grow that money even quicker. So when you think about those different aspects, it's more of like a holistic approach where you're like, okay, well, I have my money and my whole life policy, I have a little bit of money in the bank. And then you can kind of look at the different levers when you're approaching that whole scenario. But one of the things, and it's been touched on already, that I really love about whole life is the uninterrupted compound growth that occurs. And it's tax advantage. It grows tax advantage, meaning that there's ways where once I put that money in that contract, there's ways that I'll never have to pay taxes in the future. So yes, the rate of returns may not be as sexy as as, a brokerage account, or maybe, putting your money in S&P 500. However, what is important is that it grows uninterrupted compound interest. And so then with that safe money, then you can go and reinvest it. And it's already been touched on too, but the creditor protection, the bankruptcy protection, that is so huge. And the way that I kind of view the money in a whole life policy is kind of like off-grid money. So, generally you won't see that on anybody on your balance sheet. It's just kind of like tucked away in another place that nobody really knows about. And that's what makes it so powerful. So that's kind of my takeaway.
Love it. Once again, you guys are carrying all the weight today. I am like sitting here in technical nightmare hell, and we're just making it work. I got all these people texting me right now being like, dude, what's going on? And I'm like, if you only knew, just leave me alone so I can fix it. So anyway, that is that. So I'm sure what you said was amazing. I like the ending. Jeff, we're going to go to you. I got some input. Hopefully I can stick around, long enough to get this done. But Jeff, what's your take?
Yeah, for sure. So I think some of the reasons, I've got several things that I want to cover. So some of the reasons I like whole life as the banking alternative, I think the big one for me, just off some recent things that have been going on in my practice, it fills gaps that the accumulation model and the rate of return model, where you're just focusing on getting this big pile of cash and trying to get this huge number rate of return. There's things that those strategies can't always solve. And I think, as I've polled my clientele over the years, I think the thing that stands out to business owners or to people that are maybe single women or approaching retirement is the policies provide control, flexibility, but they provide confidence and predictability. You know what you've got. And I think that's the bedrock of it. And, to get more specific into some of those things, like what's the attributes about the policy that gives you the confidence? Well, I think the first one that comes to mind is the access to capital. You've got money that you can go access, yes, for emergencies, but more for a lot of the people that we talk to, it's more opportunities. If you're a construction company and you need to go buy a new excavator, okay, well, instead of going to the bank, you can restructure your finances with these policies so that you are the bank and you can go access your own capital through a policy loan inside your policy instead of having to be at the mercy of a bank. Now, if you've got credit score issues, which I've been through that in my lifetime, you can't access capital, right? That becomes a challenge. If you want to grow your business and you have those types of businesses, it can be a challenge. So I think that's one of them. I think one of the other things that stands out to me is the flexibility throughout life. I mean, this is an instrument that can really be anywhere from, alternative or supplement to savings for your children for college, the 529 plans. It can go with you throughout all stages of life and can amplify other things you're already doing with your money. And it can serve later in life as you'd call, Chris, a volatility buffer. So if you have your money in the market and mutual funds and 401ks and the market goes down, instead of dipping into your money and getting a double negative, one from withdrawing some money for your living that year and because you lost money in the market, you can let your normal monies ride, and then you can go and pull some money from a life insurance or take a policy loan, whatever that strategy looks like, to ride yourself through that. And I think that's a powerful thing. And one thing that I had recently, last year before my dad had passed away, he had done really well one year in his business. And, he's like, well, I'm going to have to repay like almost half my Social Security. And so there's a lot of taxation strategies that the policy's cash value can allow you to stay under maybe a threshold or a number that won't put you into either a higher tax bracket or even incur a tax altogether. And that's a very powerful gap that this fills that you really don't get from many other places. And I think, can't remember which one of you guys touched on, maybe Matt, you did in the very beginning, the living benefits, to access cutting edge medicine. I know, Chris, you've got your story with that. And I've got, the opportunity that could have been there with my dad, that if he had a life insurance policy on him, we could have went and sought better care for him after his stroke. And I have confidence if we had that access to capital through the policy, he'd probably still be with me right now, and that's a huge thing that doesn't come across in marketing. You're not going to hear about that, but that is a benefit with chronic and terminal illness riders that, can make a massive impact for people's lives. So I think that's a big one. And the last one I'll mention
is just the generational impact, the ability to amplify the next generation financially in a tax-free environment that's usually a multiplication of whatever you had in your policy. So if you've got, access to $1 million of cash value in your policy, generally you're going to have more than that in the death benefit that's going to go to the next generation. Whereas most other, generational transfers, it's going to be a fraction of that after taxes and fees, and we're paying off debts or whatever. The next generation is not going to get all that the first generation had that they were utilizing. So that's a powerful piece that we all know the Rockefellers have been using for many, many generations. And lastly, I think the risk part of it, I just had a conversation a couple of days ago. I was meeting with a couple clients that had policies with another agent, and they didn't understand that if you don't pay the policy loan interest every year and you're heavily using the policy loan feature, you're in jeopardy of lapsing your policy, because that policy loan interest can compound against you and put you at risk of lapsing. And that was something that, that previous agent had encouraged them to use policy loans all the time. But somewhere along the way, it either didn't get communicated or it didn't stick in the person's mind that, hey, I need to actually pay the policy loan interest so I'm not in jeopardy of losing this great asset. So.
That's awesome. Well, it's not awesome that happened to them, but, awesome that you were able to help them and give them that clarity. And I think that's a wildly misrepresented element of utilizing like whatever you want to call it, infinite banking, or utilizing life insurance as an asset, is people saying that you can borrow against the policy and not pay the loan back. There's going to be a point in time in the policy where that's a true statement. The problem is people utilize that statement as a marketing tool, and it's a massive half truth, and I'll even call that like a quarter truth, because the reality is you got to capitalize a policy for 10 to 15 years before you're able to pull that feat off, right? Like before it becomes an actuality. Not that you can't access your money and leverage it and lean on it. So I've kind of started going away from infinite banking and more towards cash flow hacking, because my philosophy is we have to utilize our policies to buy cash flow producing assets so we can at bare minimum manage the interest expectation, interest expense on those policies, right? During the first several years. And that's going to help you build growth and wealth in multiple kind of venues in life. And, there's Tyler on here, in the comments, asked, he said, why is whole life insurance, or why is an insurance company more secure and safer than a bank? And I think, even though I haven't been here for the whole video, obviously, with my technical issues, I did hear a couple things come through with you guys that I think, Ian, you mentioned it before I broke away. 1,700 banks have failed. Is that the number, or 17,000? What was the number? 17,000?
17,000, yeah.
Okay, so since the founding of our country, 17,000 banks have failed, and when you look at that number and then you compare it to one participating mutually held life insurance company has failed since 1840, I would say that that's a bit more secure. I would say that the fact that, to me, I look, and I would say my point, if I were talking about why do I love this, I'll answer Tyler's question kind of woven into my answer here a little bit, is that I believe security is a huge deal, but I think there's all forms of different types of security that we're looking for. We're looking for our own financial security. One of the statements I utilize and phrases I use a lot is that the reason people fail with their money is because their money is not in alignment with their values and beliefs, right? And I know when I look around the world right now and we talk about the concerns that people have about the fractional reserve banking system, the world's reserve currency status for the US dollar, just national debt, federal unfunded liabilities, all these different things, right? Like when you look at the inflation rates, Fed policy intervention, government, bureaucratic spending and manipulation and all these different things, right? I'm not saying whatever. I probably lean a bit more right than most. I'm a raging libertarian by nature, and I'm not afraid to just say that, because I just believe you do you, I'll do me, and as long as what you're doing doesn't impact me, good luck. That's what the free market's all about. Good luck. I'm not going to tell if you don't Like, to me, it's align your money with your values and beliefs. And the problem is like, when we talk about security, the reason that I love life insurance right now as a banking alternative, because I'm a big believer, and I say this a lot too, is that I think we need to align our money and our decision-making process, not only with our values and beliefs, but through the lens of thinking, what's the upside? What's the downside? Can I live with the downside? And when I look at the downside in a life insurance policy, and I look about, okay, well, you got to look at what's the upside, what's the downside of either alternative, right? Like, if we're looking at banking, what's the upside, what's the downside? If we're looking at a whole life policy, what's the upside, what's the downside? We almost got to build a T-chart going against each other and write those positives and negatives kind of down side by side. But you have to do so really considering and contemplating, what are your values and beliefs? What do you believe about all these things that really will have an impact on how these two different assets of your safe, liquid, accessible capital are going to perform? And when I look at that and I go, all right, first of all, I'm not as doomsday as a lot of people, right? I think I lie in more in the world of, like, my belief is that I think the US dollar is going to somehow come out on top. I don't know why I feel like that. I think eventually it will fail. I think eventually it's inevitable. I think it's naive and folly to believe that, we're going to be the only country in the history of the world that's going to endure for, forever, right? Like, so it's inevitable at some point in time. And history would say that point in time is probably sooner than later, maybe 20, 30 years is kind of like, I don't think it's happening much sooner than at least 10 to 15 years, right? So we got a good run coming out, but at the same time, 20 years from now, I'm going to be 65. So that's retirement, right? That's like, I got plenty of life left. So even though it's not going to impact me right now, and one of the biggest mistakes that people make when they're investing with strategies is doing things too early, right? Being too early to the table. And, you can be right and still lose, right? Like, a lot of people, I think, right now are saying, the dollar is dead. No, the dollar's not dead yet. The dollar may be dying, but, the ability for the government to manipulate and kick the can down the road and make it a slow, painful death is very, very strong, right? They have that ability is well within their power, and they're doing it. And they've showed an ability. And one of the biggest mistakes I made out of the gate when I first got into this business and started really thinking about this stuff was I was so extreme, and I saw it coming. And like 2010 and 11, I was just like so intense about inflation and, the dollar losing its world reserve currency status and all this stuff. And I've just gotten to the place where I believe it's going to happen. And I just think that we need to be prepared for either scenario, right? Because I have been proven wrong. 8 years ago, I said it was going to happen. And I think that there's world scenarios and there's manipulative policies that are creating all this. But the real bottom line there is, I know a lot of people that hate the fiat monetary system, right? That hate the fact that we live in this world reserve currency status where the banks don't have to have reserves, right? Like with COVID, they lifted all the reserve requirements for all the banks in the United States, and that's still in play, which is disgusting, right? Like, so once again, is your money in alignment with your values and beliefs? As Jesus just said, grab some land with freshwater source, and you'll survive. Yep. I mean, I just did. So thank you, Jesus. I'm with you. So I would say that when you look at that, though, I'm a believer that we need to look at this through the lens of what's the upside, what's the downside, can I live with the downside? And through that lens alone, I say, all right, a lot of people that are worried about the dollar failing, when we're talking about our banking money, right? We're not talking about assets. I mean, the dollar can change, the dollar can shift, right? The currency that we use, it's inevitable it's going to shift at some point in time. Everybody agree to that or no?
Yeah, for sure.
Okay. I don't know when, right? I don't think anybody knows when. And I think anybody that tells you they know when is an idiot. They're an egomaniac, and they're just trying to drive fear and, whatever. So I don't know when it's going to happen. I believe it's going to happen. So the question is, how can I like a lot of these people that are like, oh, all in on Bitcoin, all in on crypto, all in on this, all in on that. Like, put your money in gold, put your money here, put your money there. It's like, what if you time it wrong? If you follow them and you get it wrong, the consequences are dire. You know what I mean? And so what I know to be true, and I don't know of any other asset, this goes for gold, it goes for crypto, it goes for everything. I know no other asset that has actually got a proven history, right? A proven history. I got to walk around. Mosquitoes are really bad with all this rain. It's got a proven history of showing that it can manage the transition, right? No other asset, none, not one, has a history of saying, all right, you know what? If we change currencies, we're going to change with it, right? If you have your money in a bank and all of a sudden the dollar loses everything, go ask the people in Venezuela what happened to their money. Go ask the people in Argentina, you know, that the whole middle class wiped out, right? Like, granted, we've had the ability to be insulated from those kinds of things because we have the world's reserve currency status. But I got news for you: if that goes away, it's gone overnight, right? So if you have your money in a bank, your safe, liquid, accessible capital gets wiped away overnight. Your emergency fund isn't there in that emergency, right? Like, it's gone. When you have your money in a whole life policy, and not an IUL, by the way, not an IUL, but only a whole life, and this only works for whole life, and it doesn't work for IUL. And if you want to know why, it's another video. You're going to have to subscribe and hit the bell and all that fun stuff. But like, when you look at it through that lens, when you have your money in a whole life policy, it enables you to participate in the current fiat system that we're forced to play ball with, right? We're forced to. And when that game comes to an end, whether it's 10 years from now, 20 years from now, 30 years from now, whatever, and it could be sooner, it could be later, I don't know. I'm not in the game of playing this guessing game and trying to figure it out. Like, I'll do other things like buy property here and move and do things and give myself the ability to actually have a fresh water spring on property, right? That we can source our stuff and have goats and cows and, you know, stuff of that nature, that we're good to go. You know, that kind of stuff. Like, we can handle all that, and it's not very hard to do either, by the way. But it's like, the way I look at it is, if we lose it and when we lose it, and it's a matter of time, the life insurance companies have proven to be the only financial institutions in the world with a proven track record and history of successfully navigating those transitions every single time successfully. Right now, their money is in bonds. Okay, that's fair. That's where their money is, because it's the safest way to go. What do life insurance companies do? Their only job is to manage your risk and get you the best possible return with the least amount of downside, right? And so that means your upside is not going to be super sexy, but it's going to crush your bank account. So that's a benefit, you know, and it's going to provide money market like liquidity, right? Like they were saying before. Don't use your monthly need to pay your bills. Don't run that through your policy. That's a bunch of bull crap. If people are telling you to do that, please don't do it. You know, but I will say is, like, if all you do is say, all right, I'm going to keep my money here because I believe that the banking institutions, you know, and the Federal Reserve fiat currency system is a scam, and it's a Ponzi scheme, which has already been proven to be a Ponzi scheme. Look at all the banks that have failed. Look at all the banks that have failed just in the last couple of years. Go read it. Do your own research. Please do this. Don't just follow my word for it. Look at the reason. The reason is we have a lack of new deposits. That is the reason. So if the bank has no requirement to have reserves and they require new deposits to stay solvent, that by definition, y'all, is a Ponzi scheme. Like, that's not my opinion. This is financial news. Yet somehow Bernie Madoff ends up in jail, but like all these banks and, you know, whatever are good to go. Like, that, you know, the scheme is still going. And so by removing your money from the bank and putting it into a whole life policy, you're removing yourself from the fractional reserve banking system while still being able to participate in the fiat money system, which you have to do, right? And it enables you kind of the protections of both and the opportunity of both wherever you find it, right? And like, I can't remember, I think Jeff just said it. You know, there's a reason I just partnered with Garrett Gunderson and I wrote the foreword to the new version of What Would the Rockefellers Do coming out, right? And I'm doing this, and we have, this new book coming out, and I don't know if you guys all even know that is happening yet, but I just got the PDF version, and we got a bunch of print copies coming, and that's going to be coming out in July. And because the whole concept of legacy, and I always say whole life insurance is the only financial tool in the world that is a self-completing plan. What you want to happen will happen when you want it to happen, whether you're here to see it or not, right? You save money in that, and it helps protect you in all these different ways. But when we're talking about the secrets of using whole life insurance as a savings alternative for safe, liquid, accessible capital, and all the things that we're talking about, I think to me the real value, the real benefit is the fact that you get to participate in the fiat system, but you also get to keep your money with a company that is protected from it and is not like actually holding your money there. And so when whatever hits the fan, which is just a matter of time, and I think it will be during my lifetime. Does anybody here think it won't be during your lifetime?
No, I think in the next couple of years.
Okay. Right. So we can all agree to disagree or agree to agree, like whatever, the timing doesn't matter. But I think it's fair to say in the next 60 years, it's going to happen. Right. Like, and hopefully, well, 60 might be pushing 50 years. I'll still be alive. I hope, I think it's fair to say that we'll all be alive when it happens. And it's hard to find somebody. Think about that. It's hard to find somebody that wouldn't believe that. Right. So if you truly believe that, why the hell would you put your money in a bank if there's an alternative? Really think about this. Think about, why would you keep your money in a place that when you're going to need it most at the end of your life, when you're talking about like a financial, construct for legacy protection, generational protection? I would argue you right now, every single person watching this has the responsibility. If you're thinking about it in these terms, you're thinking outside the box. So A, good for you. And B, you have a responsibility, since you're thinking outside the box, to act on it. You have the responsibility and you have the opportunity to actually help your family in a way that most people are going to miss the boat on, right? To get your money outside the system, insulate it, protect it, because I promise you, when that happens, it's like what Warren Buffett always says, make money when there's blood in the streets. And when that happens, there's going to be so much blood in the streets, it's going to be ugly, and people, the financial hardship is going to be like nothing we've seen, and I just think not doing what we're talking about is just, that's why I do what I do. I love it and believe in it so much. Is like, why would you have your money in a bank? I believe in owning hard assets. I believe in using as little debt as possible. And I believe in keeping our safe, liquid, accessible capital that we're going to use for emergency and potential future opportunity, and for our generational protections and legacy planning and all these different things that we're talking about that we need to be valuing. I just think there's not another asset that's going to do what we're talking about. You know what I mean? Somebody asked, do you feel credit union the same way about the banks? Yeah. I mean, the credit unions and banks are the same thing. They operate a little differently. They're more community driven. They're profit driven, but they're still, banking on the same fiat money system. They still operate the same way. They still access loan money the same way and distribute money the same way. And, so yes, the answer is they're all the same. And I would argue credit unions are going to get hurt in this wave. I've got a video. I can't remember if it just came out yesterday. Which video? I didn't see the video that came out yesterday, but I think it's actually Friday. I have a video coming out talking about the bank failures that are coming and why they're going to come. And I don't think it came out yet. I think it's Friday is when that one's scheduled to come out. And it's going to get ugly, and all the stats show it. And this is not my opinion. It's just a matter of time. Now, I don't know when it's going to happen. And historically speaking, in presidential election years in the United States, it's a bit unpredictable, and it usually performs better than we expect. And, that's because they're manipulating it for the elections for, consumer sentiment and all these reasons, but at the end of the day, it all comes down to why is your money in alignment with your values and beliefs? And that means so many different things and so many ways to think about that. But what I look about when I think about, is your money in alignment with your values and beliefs? My question to you is, have you thought with a long enough vision? Have you thought long enough term about what you want your life to look like? You got to begin with the end in mind and reverse engineer a plan. So we got to begin with the end in mind, right? Stephen Covey, 7 Habits of Highly Effective People. We want to begin with the end in mind. All right, well, you're dying. You're 95 years old. You're on your bed. deathbed, you got your family around you. What are you thinking? What do you want? What do you want your legacy to be? You know, think about that. What do you want your life to stand for? What do you want your impact to be? What do you want, you know, your life to have stood for, right? And how do you want that transition to be? How do you want to empower the next generation? Do you care about that? Do you not? Like, these are all things that come into play. These are all things that make a difference. These are all things that should impact your strategy. If you believe that that's going to be something that is important to you, well, then now, like, the question is, what are you doing about it? How does what you're doing with your business right now? How does what you're doing with your money? How is where you're saving your money? How is what you're investing in aligning with that? You know, are you just putting your money in 401k? Are you buying stocks? Why are you buying stocks? Are you buying specific companies? Are you buying real estate? Are you buying businesses? Are you building businesses? Are you, like, what are you doing and why are you doing it? People think about is just throwing money against the wall and trying to solve these problems, and, like, without even thinking it all the way through. You got to start with why. You got to know why you're doing anything you're doing before you do it. Otherwise, I promise you, eventually it's going to catch up to you, you know? And for me, my belief is just, if we know that getting to the end, that my values and beliefs are, I want to leave this legacy. I want to leave the next generation better off. I have this responsibility in my soul that I feel every single day that I wake up, and it's the why I do what I do. So, okay, I know that, but if I also believe that the world's reserve currency is not going to be set up, or is not going to be us at that point in time, there's going to be a massive shift by the time I'm on my deathbed. Why am I not doing something about this? Like, to put myself, not that, listen, and there's no guarantee the whole life's going to get it right. I got to say that too. There's no guarantee they're going to get it right. But what I will say is, out of all the financial institutions in the world, they're the only ones that have proven they can do it right. Everybody else has screwed it up. Everybody else has failed. They're the only ones, and they're 3 for 3 since they've been around. You know? That's all I could say. I'll take those odds. They're smarter than me. You know, I could try to hoard my capital, keep it in a bank, and manage that risk, and try to time it right, and do all these things. Or I can get to a company that's been doing this for 180 years. They manage that risk professionally. They manage billions of billions of billions of dollars of some of the most elite, high-level people in the world, and the highest corporations, the politicians, all this stuff. I'll give it to them and let them manage it. You know, to me, that's why. You know, and by doing that, it gives me peace of mind. And I got news for you. When you have that peace of mind and you align your money with your values and beliefs, now you're going to execute more effectively, because your subconscious is going to believe in what you're doing. So you're actually going to go full throttle, you know, and you'll live life to the fullest, you know, and you'll feel more fulfilled along the way. You'll have an opportunity to make a greater impact along the way. And, like, I don't know, calling me crazy, but that's what this is all about in my mind.
Yeah.
Mic drop.
All right. Monologue over.
I think you said it perfectly. And you know, as you were speaking, it kind of made me think. I actually just had this. I was having a conversation the other day with a young lady, and we're talking about different investments that hit well. You know, investing in Apple before it blew up, right? Tesla. And as you were talking, the word that came to mind was, like, intentionality, right? Are you just throwing the money at the wall, like you said, or throwing it in an index fund, hoping it grows up? Or are you being intentional with your money, positioning yourself like, I want to make the right investment at the right time? And like you said, real estate, I'm a big believer in that. And just the enhancement to your life. You said something else in another video. It was rate of result, not rate of return.
Totally. 100%. I mean, that's what it's all about, the rate of result. You can't think of just a rate of return. It's like, what's the result you're going for in your life? And when I'm still going to drink that. And so when, sorry, I got someone here. So the other thing that I think is really, really important to understand, and I can't go video without talking about this, but it only works with whole life. It doesn't work with IUL. Because with whole life insurance, when you do this with a participating mutual company, and a lot of people like go, oh, Chris, all these things, like the Brian Geralds of the world. Brian, if you're watching, feel free to chime in. You know, all the people that love infinite bank, or that love IUL, and they say you can do infinite banking with IUL and all these things. What they're missing is, when you give your money into an IUL policy, you are giving up control of the results of that policy. The life insurance company, you basically strip their ability to do what they do best away from them, and now they're just speculating with the money that they would be able to protect you and insulate you and guarantee you, instead of participating with their success, then you're basically becoming a profit center. So like with a whole life policy, if we put our money with a company that's a participating mutual company, and we fund our policy and we have it done the way that we want it, we're guaranteed that our money is going to be there so long as that company is successful, right? And so we're partnering with them. We're a profit holder. We're a shareholder effectively of that company. With an IUL, you're a profit center, and that company can be successful and can be long lasting and will probably last another 180 years, no matter what happens with the financial system. But I promise your policy, if we go through a shift, is going to get buried, right? So the problem that I have with all these people like Coach JV with 3T Warrior, who's now selling IUL, which is a joke to me. The problem with Brian Jarrell and Doug Andrew and all the people that are positioning IUL as this solution, it's like all they do is look at the illustrations and they look at the technicality. And like Brian Jarrell, I was talking to him the other day on WhatsApp, and he's just like, man, the bottom line is like, I can manage these policies and I can help manage a better return. I'm like, I got news for you. If the secret to success of an IUL is you managing the year in, year out of that policy, then it shouldn't be a fixed product. It should be a variable product, and you should need a registration for it. And he goes, yes, I agree. And if they require it, I get it. I'm like, okay, but that's still, you can't then say that you could do infinite banking with it if in fact that's what it's about, because now we're not talking about it being there when all this crap that we're talking about right now happens. You know? So the fact, if I and Brian, I'm calling you out, so somebody share this with him, because the fact is, I know Brian believes all the things that I was saying to be true are going to happen, that the world's reserve currency is going to be lost, that we're going to have all these debt crises, that all these problems are going to hit the ceiling. I know he believes it's all going to happen, yet somehow he just doesn't want to acknowledge the reality that when that happens, that IULs are not protected. You're not partnering with the company at all. You're a profit center and you're totally exposed. So you're no better off than a bank in that instance. Like, you're going to lose your money. In fact, you're worse off because your money's not protected, with at least the minimal amounts of FDIC insurance that people have, even though I think that's woefully underfunded as well. And there's all sorts of facts behind that. But, I don't know. That's just the way I look at it is to me, this has got to be done with whole life. I would say the only downside is make sure you don't overstretch, right? Like, make sure whatever premium that you have, you got to do it with the right company. Ricardo Kelly asked, what company do we guys recommend? It just depends on everybody's financial situation. There's different companies that fit different use cases. We work with 5 different companies. I don't typically get into companies and answering that question. If you want to set up a clarity call, you can go down and set up a call in the link in the description, and we're happy to help you. Just, no pressure sales on that. It's just, just giving you some information. But I'll say this is, the companies, and you got to be careful because different people need different levels of flexibility, and different companies offer different levels of flexibility with whole life insurance. One of the bad reputations whole life insurance has is that it's not very flexible. And that can be the case, right? So you got to be careful what company you go with. You got to be careful how you structure the policy. You got to be careful all these things. So that's why I behoove everybody, and I implore everybody, in fact, to do your research. Never put your money into something you don't understand, and that's that. Just take the time, learn it, be willing to go slow, to make a decision that'll probably be one of the more important decisions of your life, at least when it comes to your money. That's my take. Anybody else got anything before we go?
Spot on.
No, I think you said it well.
Glad you went last, because I didn't know what we would have said if you would have went first.
Well, that's why I went last. I knew I would kind of go off. So awesome. All right, guys. Well, thanks for dealing with the technical difficulties and carrying the weight while I was bouncing in and out. I notice I'm backlit here. But I think Matt and I are going to go live tomorrow. So guys, if you found value in this, please like it, share it, get it out there to people. Make sure you go check out all these channels for Ian, Michael, Charles, Jeff, and Matt. Go check out their channels. If you get the chance, if you haven't already, if it's your first time here, make sure you subscribe, hit the bell. That way you're notified every time I launch a new video. Matt and I are going live tomorrow. I got an awesome video on bank failures in 2024 coming out Friday. And we have all sorts of content like this coming out pretty much every day. So pretty awesome. I don't think there's a better place on the internet to learn than right here as far as life insurance goes. So, and really just this foundational financial structure kind of conversation that we're talking about. So hopefully it was helpful to everybody. Thanks for being here, guys. It was fun as always. And we'll see you next week.
Take care, everyone.